Welcome back to Investing Talk Podcast.
Today we're looking at Immuneering Corporation.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us out with the algorithm and keeps these deep dives coming.
Yeah, and we're jumping into a company that is, well, it's walking a tightrope between a massive medical breakthrough and, frankly, a financial cliff edge.
A tightrope.
The stakes are incredibly high here. This is a clinical stage biotech company, and they're going after one of the absolute hardest targets in oncology, pancreatic cancer.
Pancreatic cancer, I mean, that's the one that just scares everyone. It's so notoriously difficult to treat.
It is.
Usually detected late, and the survival rates have historically been, well, dismal is probably putting it mildly.
It is. And that context is exactly why the numbers we're seeing from Immuneering are so
startling.
Their lead asset, it's a drug called imumetinib, has released phase 2A trial data.
Okay.
And it's showing a 64% 12-month overall survival rate.
64%. Whoa. Okay, hang on. Let's pause right there. For anyone listening who isn't an oncologist, what's the benchmark? What's normal?
The current standard of care usually hovers around, 30 to 35%.
At the 12-month mark.
Exactly, at that 12-month mark.
Yeah.
So when Immuneering comes out with 64%, we are talking about nearly doubling the survival rate.
Doubling it.
If those numbers hold up in larger trials, it doesn't just improve treatment, it completely rewrites the map.
But, and there is always a but on this show, especially with biotech, this is the definition of high risk, high reward, right?
Oh, absolutely.
We're looking at a company with something they call disease-canceling technology, which, I gotta say, sounds a little like science fiction marketing.
A little bit.
And at the same time, they have zero revenue.
Ugh.
Literally, zero significant revenue. And they have a history of burning through cash.
It's the classic biotech dilemma. Can the science save the balance sheet before the money just runs out? That's really the central conflict of this whole story.
Okay, so let's unpack this. We have to look at the money first because, great science doesn't pay the light bill until it gets that FDA approval.
Right.
As of the full year 2022 data, which kind of sets our baseline, the company has no significant revenue, which for a clinical stage company is expected, but the burn is real.
It is. They're focused entirely on developing these oncology therapeutics. They aren't selling, aspirin on the side to keep the lights on. They're a pure R&D engine.
Exactly. And that engine is expensive.
Yeah.
They posted a net loss of $50.5 million. That's driven almost entirely by the operating expenses for these clinical trials.
And when you look at their bank account,
they've got about $105.5 million in cash and equivalents.
Okay, so over $100 million, that sounds like a lot of money to most people.
Yeah.
But you have to look at how fast they're spending it.
Precisely. And this is where the timeline gets really tricky. We have to talk about the runway. Based on their burn rate, the math suggested their cash would only last into Q4 of 2024.
Right. And obviously we're talking now in January 2026, so they didn't go bankrupt.
They're still here. But the fear of the cash cliff, that's the ghost that's been haunting this stock.
It is. They've managed to stretch the capital, but the goalposts keep moving. They're aiming for a massive phase 3 trial. And that trial isn't expected to really kick off or show major data until, mid-2026?
So there's a gap. Even though they've managed to get to 2026, they're staring down the barrel of a very, very expensive trial with no revenue in sight.
It's a huge gap between when the money could run out and when that big payoff event happens. I mean, trials get exponentially more expensive going from phase 2 to phase 3.
Of course.
You need more patients, more sites, more everything.
However, you have to give them credit for how they're managing that burn. They aren't just blindly spending. They made some very strategic, probably painful cuts.
They did. They actually suspended their early-stage neuroscience program.
Which is a big deal.
A huge deal. They basically looked at their portfolio and said, we cannot fight a war on two fronts. They decided to starve the distractions to feed the winner.
So they went all in on oncology.
All in. And if you look at their liquidity ratios, they're actually, they're incredibly healthy right now on paper. The quick ratio is 23.84. Current ratio, 24.
Wait, 24?
Yeah.
That's unheard of. Usually if I see a company with a ratio of 2, I'm happy.
I know.
A ratio of 24 implies they're just sitting on a mountain of liquid assets compared to their short-term bills.
Exactly. It means that today, right now, they are extremely liquid. They could pay off their short-term debts 24 times over. So yes, they're burning cash, but they're not drowning in debt.
So they have flexibility.
They have flexibility to maneuver. They're not making decisions out of desperation, at least not yet.
Okay, so they have a pile of cash, but they're setting it on fire to fuel this engine. Right,
Okay.
let's talk about that engine.
Yeah.
What is this disease-canceling technology?
It does sound like a buzzword, doesn't it?
It really does.
But it's actually a fascinating, differentiated approach to the biology. Their primary moat is this proprietary translational bioinformatics platform. Essentially, they use huge data sets to map how cancer cells signal to each other.
And how does that translate into a drug that's different from what's already out there?
So most traditional drugs in this space, we're talking MEK inhibitors, they try to block the cancer pathway constantly. Think of it like trying to hold a door shut against a crowd. You just push and push and push.
And usually the body fights back. You get toxicity.
The body fights back, or the drug just becomes incredibly toxic because it's shutting down healthy cells, too.
Yeah.
And that's why these drugs have historically failed or had just awful side effects.
Right. Patients have to stop taking them.
Exactly. Immuneering's approach is what they call deep cyclic inhibition.
Cyclic, as in on and off.
Think of it like interval training instead of a marathon. They hit the pathway incredibly hard, harder than a traditional drug, but then they cycle off. They let the drug leave the system for a bit.
But wait, why would you let it leave? Wouldn't the cancer just start growing again?
That is the really clever part. The cancer signaling pathway, it takes a long time to recover and restart, but healthy cells, they recover much, much faster.
I see.
So by cycling, you allow the patient's healthy tissue to recover, which means you can dose the drug much higher without, killing the patient.
So you're outsmarting the toxicity. You hit the cancer hard, let the body breathe, then hit it hard again.
Precisely. And this all ties into their universal RAS approach.
I've seen that term, the RAS mutation. That's a huge deal in oncology, isn't it?
Yeah. It's basically the holy grail of cancer targets. RAS is a protein that acts like an on-off switch for cell growth. In many cancers, especially pancreatic, that switch gets stuck in the on position.
And it's notoriously hard to drug. I've heard it described as a Teflon sphere because drugs can't get a grip.
They just slide right off.
Yeah.
But Immuneering's tech works in about 85% of their preclinical models because it doesn't attack RAS directly in that same way. It targets the downstream effects, that MEK pathway, but uses that cyclic rhythm to avoid the toxicity that plague everyone else.
And that would explain the 64% survival rate from the intro. If you can keep patients on the drug longer because it isn't destroying their bodies.
The drug has more time to actually work. That's the hypothesis. And in the phase 2A trials, it really seems to be proving out. They're seeing a durability that you just don't see with the standard of care.
Which brings us back to the stock. Great science doesn't always equal a great stock chart. So let's pivot to the charts.
And the price action here has been, let's just call it a roller coaster.
It's putting it mildly. You're looking at a 52-week low of $1.10. I mean, it was basically a penny stock.
Left for dead.
Totally. But recently it closed near $5.79.
That's a massive recovery.
It is. Despite some pretty scary short-term drops. I mean, it fell over 50% at one point. The long-term momentum is huge. Over the last year, the stock is up 136.5%.
See, that tells me the market is finally starting to wake up to this data. You don't get a 136% move just on speculation. Someone with real money is buying into this story.
And just recently, in late December 2025, the stock jumped 19%. It's showing some serious strength.
And when you look at the chart patterns, that kind of surge often signals a breakout. It looks like it wants to test those prior highs, up near $10.
It's building a base.
Building a base and launching from there.
But it is not a straight lineup. We have to talk volume and flow because there is a war happening here. The short interest is really elevated.
How high are we talking?
We're looking at nearly 19.5% of the float being sold short. That's almost 11 million shares betting against this company.
That is very, very high. Anything over 10% is significant. When you're pushing 20%, that's a crowded trade. It means 1 in every 5 available shares is held by someone who needs the price to go down.
And get this, the short interest is up over 43%. So even as the price is climbing, the bears are doubling down. They're piling in.
Wow. That sets up a very interesting dynamic. We call it a powder keg. You have a rising stock price, driven by good news, and a massive group of investors who are losing money every single day the stock ticks up.
And the days to cover is over 6 days.
Okay, so for listeners who don't know, that's how long it would take all the short sellers to buy back their shares based on average volume.
So if everyone tried to rush for the exit at once,
it would take 6 full trading days of just buying to clear them all out. That is an eternity in the market.
It's a traffic jam.
A huge one. And it makes it very difficult for them to get out quickly without driving the price up even further against themselves.
It's the perfect recipe for a short squeeze. If more positive news comes out, those bears are trapped. They have to buy to cover, and that buying pressure can send the stock parabolic.
So we have the technical setup for a squeeze. But what is the street actually saying? Moving on to the sentiment.
The sentiment is definitely shifting. We looked at the data, and it's interesting. 4 out of the last 5 relevant articles were bullish.
That's a strong signal. The narrative is changing from, oh, this company's burning cash, to, hey, look at this survival data. The conversation is moving from the balance sheet to the clinical results.
It always comes back to that 64% number. That's the headline. The Phase 2A trial data is what's really driving the optimism.
And investors are looking ahead now. They see the roadmap. That Phase 3 trial, MPEPR 301, planned for mid-2026. Biotech investors love a catalyst, and that is a big one on the horizon.
But talk is cheap. I like to see who is actually writing checks. And in this case, the insiders are buying.
Now, that is always the strongest vote of confidence you can get. Management can say anything on a conference call, but when they reach into their own pockets, you have to pay attention.
We saw Director Peter Feinberg buy 20,000 shares on January 12, 2026. That's about $87,000. Now, that might not sound like $1 billion, but for a personal account, that is real skin in the game.
And he's not alone, right? I think the chairman, Shell, has also been buying.
He has. Insiders now own 14% of the company. That is a very high percentage for a publicly traded biotech.
It aligns their interests with shareholders. If the stock goes to zero, they lose millions. They're not just employees, they are owners.
Exactly. And institutions are holding about 36%.
Yeah.
So you have nearly half the company in the hands of insiders and big funds. The float is not actually that big, which goes back to that volatility.
Right. If half the shares are locked away, any buying pressure moves the needle that much faster.
So let's talk valuation, because even with the stock up over 130%, is it expensive?
Surprisingly, no. If you look at the price-to-book ratio, it's sitting around 1.61x.
Okay.
When you compare that to peers in the biotech space, the average is often much higher. Some comparisons put the peer average closer to 3x, even 4x.
So even at almost $6 a share, it's arguably undervalued relative to the assets, the cash, and the IP that they hold on the books.
Relative to their cash and their intellectual property, yes. The market is essentially pricing this as if the drug has a very low probability of success, despite what the Phase 2A data is telling us.
Okay, but we have to play devil's advocate. Let's look at the risks, because you don't get 20% short interest for no reason. Why are so many people betting against them?
It comes right back to that timeline gap we talked about at the beginning, the cash gap.
The runway ends. The trial starts. The math doesn't seem to work.
It doesn't. And that implies one thing above all else: dilution. The bears are betting that this company will have to issue millions and millions of new shares to raise capital.
And when you do that,
You dilute the value of the existing shares. The stock price almost always drops when that news hits. So the bears are just waiting for that secondary offering.
they think the company's going to have to go out and beg for money.
And it's not an unreasonable fear. The return on assets is negative 61.53%. I mean, they are hemorrhaging money to fund this research.
That's the bear thesis in a nutshell. They run out of cash before the finish line, or they have to dilute shareholders so badly that the stock price never recovers.
Right. But there is a strong counter-argument to that.
Which is?
The liquidity is strong enough to get them through the near term. And more importantly, we are seeing a biotech rotation in the macro environment. As interest rates stabilize or even come down, capital tends to flow back into high-risk assets like clinical stage oncology.
So the market might be more willing to give them money and on better terms.
Exactly. If they keep putting out data like that 64% survival rate, they won't have to beg for money. Investors will be lining up to give it to them.
It's a completely different dynamic. Raising money from a position of strength versus a position of weakness.
The world of difference. Raising money at $1 a share is a disaster. Raising it at $6 or $8, that's just growth fuel.
And the insider buying suggests that people who know the most aren't that worried about a crushing dilution.
Or they believe that risk is already priced in. Remember, the stock was at $1.10 not that long ago. The market had already assumed they were dead. At $5 or $6, the market is saying, okay, maybe you have a shot.
So it's a race. Can they get to the Phase 3 initiation and generate enough good news to raise capital at a high price?
That's the game. And right now, the momentum is on the side of the bulls.
Okay, let's bring this all together. We've looked at the money, the science, the charts, the risks. What's the verdict?
When you weigh everything out, I'm giving this stock a bullish score of 8 out of 10.
An 8. That's pretty high for a company with no revenue.
It is, but the thesis is just that compelling. You have science that is genuinely breaking through, doubling the standard of care survival rates in pancreatic cancer. You just don't see that every day. That's rare air.
No, you do not. If that drug actually works, it's a blockbuster.
Exactly. Then you have a balance sheet that, yeah, it's burning cash, but it's also undervalued at 1.3x to 1.6x price to book. You have insiders buying with their own money. You have 36% institutional ownership sticking with the story.
It feels like the market is mispricing the risk of the science failing.
I think so. The elevator pitch is simple. You buy for the clinical catalysts. The data is outpacing the cash burn risks. And that short squeeze potential, that's just the cherry on top.
But we need to be clear about the time horizon here. This isn't a buy it and forget it stock.
No, absolutely not. The strategy here is more of a swing trade. You're looking to ride this momentum into the phase 3 updates, which should be coming in the first half of 2026.
You're playing the run-up to the news.
Right. It could be a multi-year hold if you want to wait for actual FDA approval, but that carries a whole different level of risk. For the medium term, say the next 12 to 18 months, the setup looks very strong.
But this is for risk-tolerant portfolios only. Do not put your rent money on this one.
Definitely not. This is biotech. A single bad patient outcome in a trial can tank the stock 50% overnight. But if you have a part of your portfolio dedicated to high-growth, high-risk assets, Immuneering checks a lot of the right boxes.
It's the classic high-risk, high-reward. If they really do crack the code on pancreatic cancer, this company is not trading at $5.
Not even close. If they succeed where so many others have failed, the valuation re-rating would be massive. You'd be talking about a multi-billion-dollar company.
It is a fascinating setup. It's rare to see such a clear conflict between the financial runway and the scientific progress. Usually they kind of move in sync, but here they're literally racing against each other.
It'll be a fun one to watch. The next 6 months are going to tell us a lot.
Indeed. Well, that wraps up our look at Immuneering Corporation, a company trying to cancel cancer while racing against its own bank account.
A story definitely worth following.
As always, thank you for listening. Make sure you subscribe, like, and comment below. Let us know. Do you think the science wins, or does the cash burn bite them in the end?
We'll see you in the next one.
Stay curious.